Okay, so here we go. Uh, this is the weekly Tortoise weekend report for January 10th, 2016. We've got a market that is in bare normal conditions. So that's going to favor the short side on all of our intraday trading. The default position is to be ready to go short uh, when we hit obvious failures of support, like a new low of the day. We should be treating that as an opportunity to get short in the weakest sectors and the weakest stocks in the market. On an annual basis, using the weekly RSI 14, we're at the low end of neutral at 40 out of 100. And on a 10-day basis, using the 10-day NDX, we are deep into the oversold territory with a score of 2 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is red bearish at minus 5.82%. That means we're almost 4% deep into the bear market, and the fact that it is red means that it's among the worst readings of the past 6 months, so that's not a good thing. The 5-day slope of the 50 has turned yellow neutral at minus 0.5%. Whenever that slope is less than zero, that has been unfavorable for the market. So another piece of evidence that we get trouble. All right, looking at ADX 14 for strength of trend at 21.5, we're neutral, but the bears are definitely in charge as this market begins to look like it's trending to the downside. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold between risk on and risk off is a score of 1.0. The current reading is 0.909, which puts us well into risk off conditions. We take that score of 0.909 and compare it to the last 5,000 trading days. We find the average and the standard deviation that lets us compute the risk z-score. That's reading minus 1.14 right now, which means that that risk index is 1.14 standard deviations below that 5,000 day normal. What that means is this is just the beginning of potential sharp volatility increase, and all we have to do is look back on this 90-day histogram to see back in August that turned into something like a minus 4 sigma, and so that's I'm sorry, that was last November, a minus 4 sigma. So there's a lot of volatility that could yet reoccur here. So we are by no means out of the woods. Looking at the blended monthly rebalancing, you can see the current holdings here in the ETF 13, 22, and 32 portfolios. Next reevaluation is due on or about 1 February. These are the current readings, or the current leaders based on the close on Friday. Notice that treasuries, real estate, and then the conservative consumer staples and utilities are in the top 3. Only U.S. tech is offering any kind of hope for equity strength right now. In ETF2, the theoretical exposure is at 0% because all 10 segments of the world market model are on cash signals because they're under their 4-month moving average. The model portfolio itself is at 80% exposed with stops in place. Next up is a quick look at the ETF blended monthly rebalancing portfolios, and you can see just how widespread the selling pressure is, with everything in ETF 13 under their 4-month moving average, less treasuries, and then the ETF 32 portfolio, it's the same, only now adding staples and utilities, but everything else is suffering. And you can see that the weakest sectors remain the weakest sectors. So this reinforces the notion that when things start turning south, you want to be short the weakest sectors, not stopping and reversing your long positions automatically. In practice, our swing systems are finding signals to go long on strong companies and strong sectors under favorable market conditions. When that market itself rolls over, then and you get some short signals, you really want to be looking at these weaker segments. So for instance, in the last 1 week, notice that the bottom three, Australia, emerging markets, and Latin America, have lost almost 10, 6, and 6.5%, whereas the top three have gained 1.5 and lost 2 and lost 5 respectively. So that's like a 4 to 5% performance difference just in the span of 1 week when it comes to the leaders versus the laggards inside that population, and you see that same pattern on the 1 month, 3 month, and 6 months as well. So stop and reversing is not necessarily the best strategy when the market conditions roll over. You'll notice the same thing on the ETF 32, the difference between the top three and the bottom three, and why you want to be focused on who the weakest candidates are. Just look at the last 1 month. See, Brazil and Latin America are down 12 and 17%, whereas the top 2 or 3 are at plus 1.5 and just -2. So the difference between the leaders and the laggards couldn't be more pronounced. In the ETF Max, again, we're looking at those symbols that are green across the board to reflect the ones that have been making the big gains. Obviously, the VIX, the anti-beta fund, market neutral momentum funds. Notice those are doing well. And the rest of these are going to be bond and income type funds. You can see how China really got crushed here, leading the way to the downside. It had been a balanced winner, but now is down 10% for the month and 5.25% for the week. In the S&P 500, the ones that come to mind are these that are in the yellow. So NVIDIA, KLA 10 Core, Activision, Autodesk. See, these are blended percent winners, and yet really got crushed here in the last week and the last month. And so when you see the green and the yellows, what you're really noticing there is that on the 1 week percentage, these are things that started off in an extreme condition on the basis of strength, and then the follow through was extraordinary. So all these greens are ones that have had big follow throughs, and the ones in the yellow or red are big reversals. So from extreme conditions, you get extreme results. All right, next up is the market health check. These vertical blue lines represent 10, 20, and 30 days worth of look back. Here's the 60-day look back. The horizontal purple lines are price targets to the upside. Once we find support, that's going to be the wall of worry that we climb, the targets that we set at what used to be support levels that are now resistance levels become targets for our reversals. The dark blue shaded area is the 30-period Bollinger Band. The red line is the 30-period moving average right in the middle of that river. The lighter blue shaded area on the outside is the floodplain. That's the 30-period Bollinger Band plus or minus 2. And then the red lines outside of that even further are the Z3 lines that set the red line boundary conditions between the current normal and a new reality. And you can see that the river is getting wider, the Bollinger Bands are getting wider, that we've been riding the Z-3 here for the last 3 or 4 days as the selling has sharply expanded. And what that says is that this is discontinuous price action, that there was a significant shift in the market model. And you notice here that in the last 2 days, we've broken below the 30-period RAF regression channel, which is lagged by a day here. And what that shows is that when we close outside of that 30-period band, which is the outer black lines, then we have a fundamental change in whatever the underlying price engine was that was driving this particular move. So this says that a new reality occurred Thursday and Friday, and that price move down to 187 is not out of line whatsoever. So that's a system warning on the next higher level. And you can see that we've just dipped into the oversold conditions. The jaws at percent price oscillator have opened to the downside. Next support level down here at 187. The slope of the 30-period regression line is this black sine wave looking thing. You can see the blue dots where it has crossed the 0 line, and then the peaks are the peak steep up was here in the green, peak steep down was down here in the red. We haven't quite approached the same level of selling pressure that we saw back in September and August, but we have gone below this critical slope level of minus 0.22. Means that we are outside of the normal downward slope in a bull market. So that would be right around this price or that slope level, and we just broke through that here lately. So again, this is just entering potentially the house of pain. This has suggested that more is certainly available on the way down. So the three blue lines are the 10-period regression channel, the RAF regression channel. You see how steeply down that is. The 30-period lagged by a day is this black channel. You see that sloping down. You notice that the dragon, which is the 10-period Bollinger Band plus or minus a half, has not been able to make new highs. In fact, we've had two lower highs and then two lower lows. And you combine all this, and basically the market is really in right at a critical state here with a 10% sell-off from the previous swing high. That puts it right on the boundary of a correction. And so that's going to have some technical emotions associated with it among the institutional money managers who care about the beginning of a correction. And so I think there's more hedging and more short-term momentum to the downside is certainly the least surprising future state here. So this is not a healthy market at all. And what that says now is since we're in a bear market now, since we're below more than 2% below the 200-period moving average, which is the shaded red area, this is pure bear. And when that happens, I'm looking for intraday downward bias. I'm not carrying things overnight. I'm looking to make haste while the sun is shining, or in this case, while the hurricane is raging. And that's going to be my bias until we at least get back up to the Bollinger Band mean. So that's going to be quite a distance. That's almost 6 to 7% rebound would be required for that to occur. So my short side bias will be in place for a while, I believe. Looking at the ETF2 world market model, again, you can see that all 10 of these regional sectors are on cash. So that puts us at 0% invested, 100% cash in that model. The S&P at 55 is better than the globals at 47. And then inside the U.S., it's the Qs at 58, then the large caps at 55, then the mid caps at 48, and then the small caps at 46. The two strongest sectors are the U.S. large caps and technology in the white here. And then the two weakest sectors are Latin America and emerging markets in the red. Everything in the S&P sector spiders are on cash, with the exception of consumer staples and utilities. Those are the two defensive plays. The rest of the world market model, when you expand it out a little bit here. Again, everything in the U.S. is below average in the yellow with the exception of large caps, which are above average. Treasuries and corporate bonds have rebounded into the green. Gold is now in the white. Silver is lagging. Oil has dropped to 10 in the red. Everything Latin America, emerging markets in the Western Hemisphere is in the red. China has, even though it's in the green, has decayed quite a bit. And then the rest of Asia is suffering, as is the rest of Europe, with only a couple exceptions of Belgium and Austria. So this is a case of the whole world going down together. See the same thing in the ETF top 30 using the ETF2 lens as we saw in the blended monthly rebalancing lens, so I'm not going to repeat anything there. And in the Dow, some classic money makers are the areas of strength right now. These are the staples like McDonald's, Microsoft, DuPont, Home Depot, GE. American Express has dipped into the red on the average. And I do notice IBM is now yellow and then red, so it might be a chance to make a little of a rebound there. I also like Walmart, which used to be on the bottom, has now moved up into the white on strength and red on consistency. So that's a shorter term rebound. These things here that are white and green, such as 3M, Boeing, Walt Disney, and Chevron, white and green are signs of weakening relative strength compared to the rest of the Dow. Okay, so we're going to move on now to the daily report for Monday. And it is a target-rich environment here. And when you see this many symbols that are all testing out better than 2-to-1 on the auto framer, and you see lots of channeling and overreactions, that's simply an indication that, and also these RSI2s, that this is a broad market phenomenon and that it's really important to get the market call, the market direction right, rather than looking for individual symbols here to lead the way on their own merits. I really think you have to take the entire market strong correlations in a bear into consideration. Get the market call, the market direction right, and then make excursions from the market for your trade only where you have clear advantages. Now, what's interesting to me here is the performance of Apple on Friday. While the rest of the market was really sucking, here is Apple leading the way with a positive 0.5%, and one of the 5 symbols not on a signal on RSI2. So it may be that Apple got beat up early and took its lumps, and maybe one of the emerging leaders. I mean, longer term, every fund manager out there has to own some shares of Apple, and so this might be evidence of people buying value on dips. See the same with Microsoft, McDonald's, Verizon, and Walmart. That's nothing wrong with those. To look at them as leaders coming out of this on the next round of growth. On the ETFs top 30, we're seeing the same things. No dojis here at all. Almost everything has fired on the RSI2. We got a couple frog candidates in energy and real estate, but just look at the number that are testing it better than really even 3.5 and 4-to-1. Emerging markets are at 6-to-1 on the auto framer, and lots of 5DDs as well. And so be very, very concerned about getting the market direction right again, and not trying to go too deep or too far from the market to look for excursions. I think it's important to get the market and the volatility right. So that's the way I'm going to play it. A ton of auto framer and RLFF candidates. I'm not going to read them all to you, but I'll just repeat my remarks about getting the market call correct. And on the pinch, JNK and NSC are the only ones that have pinched. With this expanding volatility, that's not really a surprise. You can see here on the additional charts in the market mosaic, this downward slope of the 30-period regression line, and that's accelerating to the downside. You can see the polynomial regression line has rolled over and crossed underneath. You can see that the 30-period is now more than one standard deviation away from the long-term average, and the jaws compared to its own 10-period are expanding. You can see that the percent stretch of price relative to the 200-day moving average is now 2 full standard deviations below the long-term normal. You can see just how sharply this move has occurred. Notice how smooth these moves are, these directional indicators here. The slope of the RL30 is a very good barometer for market health. When it made its own crossover here, more than 2 standard deviations above, we suggested time to start tightening it. That's the first rejection or the first failure of the upward test here, and we've had nothing but suffering since then. So pay attention to the slope of the 30-period regression line. These are some of the longer-term parts of the market mosaic. You can see this is looking at the slope of that 30-period regression line. Now looking back over the last 10 years, you can see now that we're almost 2 full SDs south of the long-term average. So there have only been 1, 2, 3, 4, 5, 6, 7, 8 times where it's been this bad in the last 10 years, and each time has been followed by a nice upward pop. But the point is that it can get an awful lot worse. It can get as bad as these 3 spike downs before it gets better. You can see that volatility is on its way up, whether we're looking at price divided the 30-day average price, or whether we're using the ATR percentage volatility. But in neither case has this reached previous extremes. So that's why I say there's still plenty of room for more pain and suffering here in the short term. Just flip through the fail stats, gain stats real quick. Only gold and treasuries are anything other than red. This is the Z-score of their swing trade time frames, depending on how much they've made or lost over the last 40, 20, 10, and 5 days compared to the long-term normal. Everything's suffering. This one is a pretty telling story here. What's important to notice on the slope of these regression lines is that the 90 has just rolled over from that plus 1Z, so there's still plenty of room for this to get worse, like all the way down here. This spike down can get worse, and it really 185 is within play on this move. The fact that there were 3 lower highs, 3 lower lows, and hasn't reached that previous price level before says there's still strong reason to believe that 185 is in play. All right, that's everything I wanted to cover on the daily report. I just want to take a quick look at some of the charts from the chat room this week, just to show you some things that are available. Excuse me. All right, this is one from Friday, the early morning trade. This is a case where the market gap down, so that we're looking at VXX. So this is inversely strong compared to the S&P. The market gapped up and then failed. So what you expect to see then is VXX gapping down, failing, but then the market began to fail. So VXX and volatility starts to go up. So this is what 2 pattern 4 RLCO frames. And pardon the crude graphics here, but I'm trading off a tablet at this point in the classroom. But even with primitive tools, you can still see these patterns. You can see the river. You can see the 30-period moving average. And what we have here is a low, a higher low, and then a 1, 2, 3 entry. That's essentially a P4. This would have produced a pattern 1 RLCO, finding support at the Bollinger Band mean, and then taking the resumption of the trade. So this is an entry around 22.75. And it gets up to 23.40. So we're talking about 70 cents on typically a 30-cent risk. So this is a 2R trade on pattern on this trade number 1. It sells off, comes back to the Bollinger Band mean, finds support and holds, where I ended up holding until that red dot, so I didn't get the full. This is probably about an hour's worth of trade, and sold off, but then found support at the bottom of the Bollinger Band river, a re-entry. This is another pattern 4 where it's a higher low, and then it takes off. Now this thing ends up getting above 24 by the end of the day, but I just want to show you that getting started on these pattern 4s can be done early just by being sensitive to the early morning support and resistance levels, and essentially getting the direction call correct in the market, because right now in this sell-off it is the market direction that matters. Excuse me. Okay, it's late already, and I want to get this posted. Get the market call right. I don't want to overthink the targets for the morning, but my scenario is going to be, if I've got weakness in the market, I'm looking at to go long VXX or short Latin America, Brazil, and if we get any kind of bounce in the morning, then I'm going to start with XIV and then probably the Russell pair, and then US tech. So that's going to be XLK, Apple, and Microsoft are going to be my targets on the long side. If we get anything like morning hooks, or trying to find support here at the 10% sell-off level. Okay, so that's everything I want to cover for right now, and we got more work to do in the chat room. Keep your risk measured and your powder dry.